This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, August 3, 2026, and this is the New York pre-market. Now, let's get into it. Consumer discretionary is charging ahead, up more than 3%, while materials are getting crushed by over 2%. We are witnessing a market that is splitting down the middle, where big cap resilience hides a widening gulf between the lucky few sectors and everyone else. As we open this critical earnings week, the question isn't just what's up, it's who's left standing when the dust settles. Before we dive into the tape, let's look at the calendar. Today, Monday, August 3rd, brings the ISM Manufacturing PMI. This is the first major gauge of factory activity since the last report, and with the services side showing mixed signals, manufacturing data will set the tone for industrial sentiment heading into earnings.
For the ISM data, don't just look at the headline print. Compare it against the consensus expectation for the degree of surprise. A miss here could fuel the narrative that growth is slowing faster than the soft landing model assumes, directly impacting the energy sector and the industrial sectors we're seeing today.
Let's look at the pre-market snapshot as of 9:20 Eastern Time. The major indices are mostly green, but the breadth tells a different story. SPY is at $747.03, up 0.72%, and QQQ is at $687.99, up 0.65%. But look closer. IWM is the only major index in the red at $291.20, down 0.48%. Let's talk about the movers driving this pre-market action. First, GameStop. It's gaping down 6% to $20.42 on 3.6 times normal volume. This isn't just noise, it's a massive liquidity event tied to merger news with Supernus. That volume spike is the key metric here. Retail traders are exiting en masse. When you see that kind of volume on a single name dropping 6%, it usually means the meme bid has evaporated. And because GameStop often acts as a proxy for retail sentiment, this exodus suggests retail capital is drying up in the equity space right now. On the flip side, offshore yuan industrial is up 10% to $11.28 on a Q2 earnings beat. In a sector where the industrial sector is barely positive, this is an outlier.
This is pure fundamentals. Offshore yuan is beating estimates, which proves that, while the broad industrial sector is weak due to macro headwinds, individual companies with strong order books can still thrive. It's a stock-specific win, not a sector-wide tailwind.
And finally, ServiceNow is up 3.8% to $115.50 ahead of Palantir's earnings. This is a tech rotation play.
Be careful with that rotation. ServiceNow is rising on anticipation, but remember the yield curve is flat at plus 0.47 percentage points between the 10-year and 2-year. When yields don't expand, high multiple software stocks become vulnerable. This jump feels like a squeeze short move rather than organic accumulation.
Let's dig deeper. First up, let's talk about the S&P 500 ETF, SPY, at $747.03. It's sitting just shy of its 10-day high of $750.02. Grid, you've been watching this level closely. What is the technical picture telling you?
The structure is stretched. SPY is essentially testing the ceiling of its recent range. We are within 0.4% of that $750.02 resistance. Normally you want to see volume expansion to break through, but look at the internal divergence. SPY is up 0.72%, but the Russell 2000 IWM is down 0.48% at $291.20. That's a classic divergence. The large caps are propping up the index, but the small caps are failing. If SPY touches $750.02 and doesn't snap through, it's going to reject hard.
And that rejection is fueled by what I'm seeing in sentiment. The retail crowd isn't participating in this rally. Look at the sentiment scores. Apple is negative at minus 0.62, and TSLA is negative at minus 0.33. These are high beta names that usually lead retail enthusiasm. They are lukewarm. So when you combine grid technical resistance with my sentiment data showing retail fatigue, the odds of a clean breakout diminish significantly.
Exactly, and don't forget the VIX. It's at 15.99, which is quiet, but it's been whipsawing between 15.82 and 20.88 recently. That compression is dangerous. If price hits that $750.02 wall and sentiment is this thin, we could see a rapid unwind back toward the $744.68 pivot level.
So we have a technical wall meeting a sentiment vacuum. CIPHER, let's look at the fundamental driver behind this. Why is SPY even pushing up if the breadth is this poor?
Because capital is fleeing to quality. Specifically, look at the sector flows. Consumer discretionary is up 3.29% today and 6.11% week-to-date. That is massive outperformance. Investors are dumping defensive plays like utilities, which are down 0.69%, and instead piling into consumer-facing growth stories. It's a flight to quality within the risk spectrum. They aren't buying the whole market. They're buying the specific names that can deliver earnings beats regardless of the macro slowdown.
I'd argue that's a fragile foundation. You're calling it quality, but the macro data contradicts that. CPI is still sticky at 3.46%, and GDP growth is slowing to 1.5%. The Fed funds rate is holding firm at 3.63%. You cannot maintain a 6% weekly gain in discretionary spending when borrowing costs are this restrictive and growth is stalling. This isn't quality, it's a valuation bubble in a narrow slice of the market. The lack of participation from materials and industrials. The materials sector is down 2.34%, means there's no economic justification for this premium.
But the earnings reports this week might justify it. We have now up 3.8% ahead of PLTR. Software and services are showing pricing power. The market is anticipating that these companies can pass on costs to consumers, unlike the manufacturers who are struggling with input costs.
Well, if they pass on costs, eventually the consumer stops buying. And that's where the technical breakdown happens. Once consumer discretionary starts to falter, which grid sees happening if SPY rejects $750.02, the funding source for this entire rally disappears.
Let's pivot to the biggest loser in our scope. GameStop, GME, down 6% to $20.42. Pulse, you flagged this earlier. How deep does this sentiment shift go? It's not just GameStop. It's a symptom of retail exhaustion. We saw the volume hit 3.6 times normal. That's not a trade, that's a capitulation. When retail exits a name like this, it removes the bid support for other speculative, low-float names. Look at the OTC chaos. FNGA down 95%, JDZG down 88%. Retail isn't just selling GME, it's pulling margin debt from the entire speculative ecosystem. This reduces the liquidity available for the next big meme trade, which means fewer buyers for the next earnings runner. So, less liquidity for speculators. Does that spill over into the broader tech sector? Indirectly, yes. Look at Coin. It's up 1% with a perfect positive sentiment score. Retail money is trying to find a home. They're leaving equity memes and looking at crypto-adjacent equities. It's a substitution effect. But if GME keeps bleeding, the overall confidence in high-volatility assets erodes. Let's talk about the yield curve, specifically the 10-year versus 2-year spread, which is at plus 0.47 percentage points. SPECTER, you mentioned this is risky. Why is this number so alarming right now?
Because it's a leading indicator of constraints. A spread of plus 0.47 means the curve is nearly flat. Historically, when the curve flattens to this degree, it signals that the bond market expects slower growth or imminent cuts, but the equity market is acting like growth is accelerating. This mismatch creates a trap. Stocks are priced for expansion, but bonds are pricing for contraction. That tension usually resolves in a volatility spike, and with the VIX at 15.99, that spike would be painful.
Technically, I agree with the risk. If the 10-year yield doesn't move higher, tech multiples get compressed. Gridlock at the upper bound. If SPY fails to break $750.02 and yields stay stuck here, the technical repair is inevitable.
Apex tie this together. We have SPY hitting resistance, retail exiting, and a flat yield curve. What is the structural takeaway?
The takeaway is that the current rally is a narrow leadership trap. Grid correctly identified that SPY is at $750.02 resistance, and CIPHER noted that consumer discretionary is carrying the load. But Pulse highlighted that retail sentiment is turning negative on high beta names like Apple, and SPECTER warned that the yield curve spread of plus 0.47 is constraining valuations. When you combine a narrow sector leader with a lack of retail participation and a restrictive macro backdrop, the risk-reward for chasing SPY at $747.03 is unfavorable. The market is front-running a soft landing that the data hasn't confirmed yet.
Final thoughts. We have a market that looks good on the surface, SPY up, VIX down, but underneath, the foundations are shifting. Here is what we know as we open the markets. First, SPY is approaching a critical technical barrier at $750.02, supported by a narrow band of consumer discretionary strength, but lacking broad participation from small caps or industrials. Second, sentiment is fracturing. The massive exit from GameStop and negative sentiment on Apple and Tesla suggest retail liquidity is drying up. Third, the macro environment remains constrained by a flat yield curve and sticky inflation, limiting upside potential for high-multiple growth stocks. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.